following is a presentation of TFNN. The Global Market Pulse with your host, John Logan. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, John Logan.
Hi, guys. Welcome back to the show. Got a big problem here with Greece. We're going to talk about that. I can't believe those people have voted no. It's a stubborn crowd for sure. Don't think they really totally understand what they're getting into here. And I'm back actually in the United States, so that's a good feeling for me. Spent 20 hours on one plane actually. Try that sometime. 20 hours on one plane to get back here from Hong Kong. We had to sit on the runway 4 hours before we left, and it's about a 16-hour flight. So, and then the wonderful folks in customs here in Chicago, just welcome with both arms. And Chicago is nice weather today. I'm looking out the window here. Can't give you a video because I'm still on the road. A little bit compressed here as far as equipment. Spent some time with Steve Dahl last night, had some really good conversations at dinner, and got some good things planned for you guys over the next couple of weeks. As you know, we've completed a lot of software projects, and I think you guys are going to be, great in a good spot to be recipients of all those. So I'm excited to get those out the door and get some feedback from you guys, and hopefully that will be some great tools that you can have at your fingertips. Hopefully, increase alpha, as they say. So we're going to take a look initially at the euro. And again, if you hadn't been reading the news reports and you just woke up, the Greek population voted no. Still can't believe that. Their finance minister has stepped down. Germany and France and the rest of them are trying to figure out what the heck to do, having meetings. I guess the size of Greece relative to the euro is basically, I think somebody coined, about the size of Wisconsin, the state of Wisconsin, relative to the United States as far as economic conditions go. So again, not the biggest thing in the world, and the euro is just not really showing a lot of reaction to this. It's down, obviously. We were looking at this 112.25 area before as the leverage point. I don't know if you remember that past couple of weeks. We were talking about that particular number was the one that we were going to try to short against, stops above. We really like this consolidation. I didn't like the reversal here, but again, that number was something to lean on when it comes to the euro. And now we've broken down below profiles on a daily, had a new pretty thin profile appear. Excuse me, this is our daily on the euro I'm showing right now. And as we kind of drill down into the weekly, we're sitting right at some targets that we've got. Actually, this morning we had a new box appear, new profile appear. Unfair lows are at 109.48.49. So we're going to take a look at this. We've reached a low today of 109.70. So 109.48. We did an article, or I personally did an article on Bloomberg. It was a Bloomberg brief recently, looking at, and excuse me, guys, I've got one screen here. I'm going to have some real estate coordination issues here to deliver this in the den. But we looked at this 114.50 into 115 areas, major resistance in that article. If you want to catch it, it's on our website. You can probably go online on Bloomberg.com and see it. But we talked about, that was the leverage point for the euro for this thing to continue to fall apart. And I don't really feel that this 109.48.49 being the unfair lows in our weekly are going to be the stopping point. But right now, you've got a pretty serious inflection point you've got to pay attention to. And that's a pretty target-rich environment, especially when you're coming down from 112.25. You got about 250 basis points in this, or 250 pips in this already. Even though we've gotten below the daily unfair lows, remember those weekly numbers take precedence over what's going on with the daily. So we're going to go into the scanner here. I'm showing our TAS profile scanner. This is our heat map grid. These are the global indices on a daily scene, and here's the weekly scene. And this is what's kind of amazing to me. Here's our S&Ps. We talked about this. We're going to get into this in a little bit, but what I want to do is I want to go into the Forex section. We've actually added about 20 to 25 new Forex pairs, and this is an awesome product. If you guys don't have a demo of it, please get it. This week, Steve and I are going to try to do some crackpot videos on this thing that are hopefully going to explain exactly what you're going to do when you open it and try to coordinate your trading day around this thing. I mean, it's got so many different features that I think people, see it. It's a little to digest at the beginning, but we're going to try to make some Betty Crocker type videos on exactly what you're supposed to do from the minute you open this thing, and what we do, I guess more importantly, using our own product and how we use that to guide our trading day. So we're going to take a look at the euro really quick on our heat map, or on our regular grid here. EUR, where are we at here? There we are. So as we can see, those inflection points, 109.49, bottom of the box 110.91. We just surpassed that. So we're looking at that, and we can go in here and look at our landscape. You can see where the level of the market is relative to what's going on with the current multi-time frame euro landscape. So as you can see, we still haven't eclipsed that weekly, and we've actually gotten very close to it and come off of it. This was something that I wanted, this particular feature that I wanted in the scanner, just to show me all the different time frames that we monitor in one glance and where the level of the market is. Now the good news is we sped up the, if you don't have real-time quotes and you're looking for something that's going to give you real-time signals and real-time action, this does it based on a 60-second refresh, and you're basically allowed to, get updates on the marketplace basically without, having to go through. We're not giving you prices of the markets, but we're showing you where the market actually is within the scanner. So again, going back to the euro, got a little bit of a resting point possibly around 109.48.49. We've got 109.84 sitting here on the 240s. There's not a lot to tell me that this is going to, you want to see action kind of migrate away from those major inflection points, and we're right back down around that 109.49. So that's not exactly bullish, but you got to pay attention to that inflection point. And we've had a good ride down since 112.25, so I think you got to at least look at taking off some of the position there. I want to go also, before we start getting into some of the things that are, reacting violently to this Greece news, the ruble, this is something we've had on our radar screen. We've talked about this, and I just want to keep pointing out, we've had stops below 53.12 on the rubles. Think this thing can still go higher. Dollars actually. And here's the latest box. Now we're getting above this ruble trade. That's something we've been paying attention to on the currency side. Let's just kind of go through a couple of other things. The Australian dollar, this is one we've been extremely bearish on, and I'll show you why. This is something that we've talked about. 76 was our target-rich environment down here. We had a little bit of a rally here to get into some more shorts, and we talked about this thing eventually eclipsing 76. Now we're in the 74 area. So, what do you do with this now? This is the Australian dollar USD. There's no end in sight to this. I mean, this is probably going to get more and more ugly. We've talked about this. We talked about, shorting the Australian dollar at, last particular tranche down 94. We haven't had really any reasons to get out of that trade. This is 2,000 pips ago, except for some disturbances when we got above 78.93. This is all delivered in the scanner. As we look at this, I want to go back into the scanner, and I want to pull up my Forex, and I want to go into the Aussie dollar USD. As you can see, we're red across the board on these time frames, giving the inflection points and using this as a guidance tool. Here we go. There's the level of the marketplace. And by the way, we put a feature in here. Taz says you can basically, go in here on any term view, long-term, intermediate, and short-term, and get a automated text, not totally as if I were saying it, but very close to it. The long-term trend is favorable to shorts and has been enforced for 3 weeks with that last breakdown. Primary long-term resistance at 76.54 now. Be on the lookout for new weekly profiles. We've got some new numbers on the intermediate it gives you. This is a really cool product that I think makes it pretty easy to figure out what's going on from a red light, green light situation, and also be able to get some automated text to kind of guide you through that. Now, what we normally have, based this entire product on is doing filtering. So I've showed you a little bit about a Forex grid. We've talked a little bit about some features in there, mouse over levels, things like that. We're going to do some drill downs a little bit later in the show today for some situations in the S&P. I know you guys watching the show right now are pretty much focused on the S&P and the internals of the S&P. We're going to do some filters to try to find some stocks that are showing their hand a little early when it comes to relative strength trading within the index itself. I'm going to have to check our time here every once in a while on our screen. So I apologize for that coming up there. So that's the Australian dollar situation. Don't see a lot of reasons to take this off. That you've seen the daily, the 240. The 240 short-term levels are 75.19 on the Australian dollar. As you can see, we've leveraged off that a couple of times. Short-term stingy traders on the short side would put stops above 75.48 on this particular trade, while at the same time allowing this thing to breathe a little farther down south. U.S. dollar, again, a little bit of a safety play. It's not like I have to explain that to you right now. Getting back above that 95.30 and now 95.75. I'd been a big fan of waiting patiently to buy the dollar again, not really getting that bearish on it as some folks have been doing. I think it should be rallying a little bit more than this actually on all the news, but it is what it is. Here's the weekly. We've talked about this 95.30 area a lot. Now we've eclipsed the daily. Now you've got short-term support or intermediate-term support, 95.75 like we've had. And to regulate that trade up, you've got some 240s that you can place stops below 95.93. So I've said a lot there with a lot of numbers, but the bottom line is still bullish on the dollar. Short-term stops below 95.93, longer-term stops below 95.75. Okay, still monitoring my clock here. So let's move right into the S&Ps, and then we're going to do some drill downs in this a little bit later. The news out of China, I know you guys have probably been reading some articles left and right. I just left Hong Kong myself, that 20-hour plane ride from there. So what the score is in the Chinese brokers right now, they're basically so-called putting their money where their mouth is. We're going to talk a little bit more about this when we come back from break, but the bottom line is they're supporting their own stock market in a sense, just like we're supporting our own treasury market. So we're going to talk a little bit about the ramifications of that when we come back off this first break, guys. We'll be right back.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You've always taken the long view when it comes to investing, but what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while seeking to reduce your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. John takes your phone calls. Now, toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi guys, welcome back to the show. We had left before the last break, we were just kind of getting into the Chinese brokerage situation and their market. I mean, you can't, in my opinion, you can't really complain too much about having a blast since, God, let's just call it November last year, October. We do over 100% move. And then we have a pullback. This is a pretty violent pullback, but this is what happens when people are leveraged out in their brokerage accounts. I personally thought it was time to try to pick some battles around 44.50 and 4,200. What happens, we broke through there and then came back and retested those numbers. So, no harm done not getting back above those areas and being able to, try to wait for some confirmations as we go north on the Shanghai. So this is what happens. You avoid some nightmares when you play the profile game. Sometimes you hit some grand slams, but the thing that we always talk about is, how do you use these things for confirmation, and how do you use them to avoid trouble? Well, this is a pretty good, example of how to avoid trouble in this. So, they had the news that they were going to come out basically, and, don't discount, by the way, even though with the price action today and the Shanghai kind of, closing up, but not really closing on the highs by any means, and having another really volatile day. This is a daily chart of the Shanghai, and this is the action today. The good news is we've had an orange bar. We more than likely will have a new profile lock in tomorrow morning, so pay attention to this. We'll have new numbers to key off of on the Shanghai, a new daily profile, which is really good. It's actually considered a new demand area. I'm going to take that as actually a very positive bullish sign for the Shanghai marketplace. But what I want to say is, don't discount the Chinese government, central bank, whatever, ability to fix this situation, at least temporarily, because they obviously can manipulate their currency. They can, step in and do what they have to do, so-called, buy their own stocks. They can, force the brokers to do certain things. They can actually restrict the population from even selling if they want to. They could say, you know what, no more sales. That little trifecta is a pretty guaranteed way to stop a stock market from falling, at least temporarily. So, keep all that in mind. They're not beyond, and, just like we've done. I mean, we're not immune to doing things like that. We've been in a Treasury buyback program, or buy program, for, well, we stayed in that for over 5 years, so maybe 6. Anyway, just giving an example of how, and that seemingly worked out relatively well, at least in the interim, so that the Chinese government could stay in that frame of mind for a while. And I'm not able to watch the den, guys, in the comments until we have breaks, so apologize for that. Let me see where we're at here. Okay. All right. So that's the situation with Shanghai. Let's, taking that into consideration, the global markets haven't really liked the Greece thing, the Chinese thing. We don't know where that's headed. That could just throw a lot of different globally related markets to China consumption and economic numbers coming out in their market, depressing all the population there, blah, blah, blah. That could throw a lot of different global market indices into some form of volatility in the U.S. stock market. The S&P 500 is not immune to that. So as we look at this, we're going to take a look at the weekly situation, the 2060 areas, the big area on the weekly. That's where we have kind of come back and retested. We're going to get a little bit farther into the numbers here in just a little bit. Let me see if I can get this turned off here. One screen is a nightmare for me in the morning. So as we look at this, we're going to go into our scanner and try to do some drill downs. I'm going to pull back up our weekly here. We've obviously gapped down this morning and rallied back up. We've had a low this morning of 2034, and we've rallied actually into a high of 2059.25. So that 2060.35 was met. This is really, really interesting and nice for shorts, because you want to have things to grab onto down here, and we've had some numbers come out from China, some information, and we've had some volatility. That remembering those weekly numbers take precedence over the daily, over 240 and down the line. So again, haven't had anything to really lean on. Here's our 240-minute view. We talked about last week the 2079, 2075, 27 to 70 area that held. Tom was very right on that. And we're going to talk about some more numbers when we come back after break.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
If you're like me, you're always looking for ways to diversify your financial portfolio. Everbank's innovative Market Safe CD can help you diversify while protecting your principal deposit. In fact, Everbank unveiled a new 5-year market-safe power metal CD, which combines the power of gold, silver, and copper. Metal prices are currently low, so this CD could really deliver. Consider the facts. You get exposure to 3 valuable metals in one index CD and have the potential to earn up to 45% capped upside payment at maturity if the metals increase in value across annual pricing dates. And should they decrease? No worries. There's zero risk to your principal here, as you still get 100% of it back. Keep in mind, returns are based on CD performance. No annual percentage yield or periodic rate of interest is paid on the CD. Intrigued yet? The July 9th funding deadline is quickly approaching, so hurry over to everbank.com/TFNN-CD for more information, including important product details and disclosures. Once again, that's everbank.com/TFNN-CD. Everbank is a member FDIC.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartleys, ABCs, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com. Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi guys, welcome back to the show. Had a question in the den I want to cover. We talked about the S&Ps right before the break. Just want to continue that, and we want to always, just on a long-term basis, again, just to hammer this home, the more important inflection points, as you can see, and these are determined, well before the, and this is, man, this weekly's been in force since beginning of March. Wow. Okay. So we're going, okay. A couple of things to note here. The longer a profile stays in force, the more powerful those inflection points are. So, we talked about, again, and the more importantly, I'm not talking English perfectly this morning, sorry. The most important things we want to talk about, again, are the inflection points the longer a profile stays in force. But we don't talk about POCs that much. I don't. They're basically rocker arms for the profile itself. So consider these kind of the peak of the, if you're looking at it in a 3D type view, these are the peaks of the mountain range, so to speak, or whatever. So, everything on this side kind of falls this way and everything on this side falls this way. And when we cross those borders, it makes it a lot easier to roll downhill, if you know what I mean. So this particular line here, this POC, which the longer this profile stays in force, the more we have to pay attention even to these numbers. This 2075 area, Tom was talking about this last week. And we were trying to leverage off of that. So we had a POC on our daily around 2076, 2077. We had some situations going on our 240s, which were resistance levels around 2079. We reached a high the other day, actually, when I was not doing the show, of 2079. So we talked about a DMZ between 2075, 76 and 2079 that the S&Ps you could pretty much leverage on the short side against that resistance zone, if you will. That worked out quite well. Again, over the weekend, I just couldn't understand how anybody would want to even hold anything long going into a decision like that. But, again, these people have been so accustomed and brainwashed into, somebody's going to make everything okay. Yellen, whoever, Merkel, the Bank of Japan guy. If everybody's been accustomed to that, then there hasn't been the fear going into situations like this. I mean, to be honest with you, all odds, if you play that game and you look at what's happened in the past, a lot of people might have been thinking, well, why wouldn't you go long into the weekend? But again, this is kind of a good lesson to wait for those situations to happen and then try to trade the reaction. And what's happened this morning is we've gapped down significantly, and we've rallied 30 points, but we've hit the strongest inflection point to the tick. So again, here's the 2060-35. We reached a high of, 2059, 25. So I'm going to call that satisfied. And we backed off 10 points from there. So again, that's going to be your major resistance level on these moves right now. I don't think this is over. I think, we had to gap down significantly. Some people are getting out of the marketplace. You'll probably see some people that are stock traders come in and not, maybe buy the dip a little bit, even though it's, again, probably made the major move up already. I don't see people clamoring with the Chinese situation, the Greek situation, who's next type scenario. I really don't see people clamoring to buy stocks this morning. I know that, it's buy the news type situation sometimes. I think there's some pretty serious losers on the wall, if you will, that people are going to have to really rethink what's going on. And with the Chinese government and the mandates that have happened, and really not the reaction in the Shanghai that people wanted to see. I mean, of course, the Shanghai, closed up today. I was actually watching it during the night because I couldn't sleep. The reaction exactly wasn't the rosiest situation. And I think a lot of people trading equities are just going to be looking at all that. Like, is it really time to step in and go long stocks in the U.S. stock market? Now, we've been talking about, and I'm going to get to your question in just a second, John, about let me just answer it now. When we have profiles appear above price action significantly, especially like this, those are extremely bearish signs. Just as conversely, we have them appear below, those are extremely bullish signs. Now, when we had this happen, we had it happen, I'm pretty sure I was traveling when this happened. This basically means that price action moves so quickly away from a designed balance area that we couldn't catch up to it. Now that didn't happen here. This happened here on this day. So this profile was emitted on the 2nd, and we were well above price action. And we talk about this all the time religiously. These are extremely bearish signs in this instance. We had this happen on the DAX. We had it happen quite a few instruments we talk about. We kind of lick our lips waiting for these types of scenarios to happen. So it can't catch up to what's going on down below. It outputs a profile because it has to, based on the algorithm. And those are just conversely on the long side, when profiles appear below price action, those are extremely bearish situations, and bullish situations conversely. So just to cover that, but what we've been basically preaching is this is our S&P. We've got breadth charts on 16 different global indices and quite a few ETFs. We're adding ETFs to this right now. Here's the ETF situation on the weekly, and again the XLV holding in there like a champion on the long term, and obviously on the daily still hanging in there. The only positive, you got the XLY here, barely hanging on. We're going to see how things open today. A lot of these numbers are going to flip-flop around because some of these stocks haven't opened yet. They're starting to open. But if we go into our we're looking at our daily grid on the S&Ps here. We're just going to, or on the global indices, we're going to drill down into the S&Ps. We're going to look at our breadth charts. And if you remember, and by the way, we put a little price relativity chart in here so you can see this on the daily, the 4 hour. And there's whole trading systems we build around breadths, but let's just take a look at the daily situation here, or excuse me, the weekly. We had this start to happen around July or June 4th. The last time we went breadth negative like this was September 26th, and then we crossed back over October 24th into positive areas. So that was where we were supposed to be net positive on a long-term basis from then until that June 4th area. So now we're supposed to be net negative, and we have been net profile negative on our long-term since that July or June 4th area. So again, this is something we pay attention to. It kind of changes the tone of the marketplace, or the tide of the marketplace, as Basil coined it one time, which I love that term. The dailies had given us, this is our daily breadth crossovers. I'm going to kind of blow this up so you can see it a little bit better. The dailies had just been relatively confused since we started, mishmashing together around July 25th. So at that point, it was really time to really start ignoring with some of the volatility that we had, and then some of the weeklies that were starting to show pressure. Remember, the weekly crossovers started. I'm sorry, I got the wrong. That's the weekly. I'm sorry. This is our daily. Sorry. As we look at the dailies, we started getting a little confused here as we look back in time, and we started talking about there's really not a lot of cohesiveness going on in the internals of the marketplace. Since March, really, we've been opting out on longs, and if you guys have been watching the show, we've just been looking at short opportunities. Even though we were above weekly and daily profiles a lot of the time, we were looking to our 240s to get inflection points to short off of. So again, this is just good case in point. Looking at our dailies is kind of an indicator of or Behringer of bad news, if you will, for the longs. And then we had the massive confirmation happen around that. We had it first on the dailies around 522. We started being breadth negative then, but then we had the weeklies actually cross over 6.4. So we got the latest, and we started widening hard. If you can see that, I mean, that's pretty serious. Widening of net profile negative numbers starting back 522, and then it was really the Katie bar the door June 4th, first time it happened since September 29th, or that number, whatever we had last time we went negative like that. So again, that's kind of some of the indicators that we look at, along with what John from Philadelphia had asked a question about. We've recently, the past couple of days, had a profile on our intermediate appear well above price action. So all these signs starting initially on the daily 522, then the weekly 6.4, and then we've got some other confirmations lately. I know the fundamental news has kind of helped this whole situation down, but it's amazing how the technicals really forecasted this ahead of time. And this was a rare occasion. We don't get weekly crossovers that often, and we could stay weekly breadth negative for a while. So that's interesting in itself. Let me see if we got any more comments. Okay. So that being said, what do you do with the S&Ps? I think you still have to be with the breadth situation the way it is on the weekly and the daily. The situation on the daily, which profiles have appeared above price action, that's very similar to what's going on with the 240 here. And you've got a major inflection point at 260.35. I think you got to put stops above there. Be willing to get back in the shorts below 260, 2060 if you get stopped out, and continue to play the game against that 2060 area. So that's my take on that. Let's take a look at gold really quick and the 10-year. I mean, these are just amazing times with this particular news out there. Here's the daily situation on gold. Here's the daily situation on gold. On the 10-year, we talked about that 125.24 area, and the weekly, that 127 11 area that we've got to talk about. But I think we've got a caller, Victor from New Jersey. Are you there?
Yeah, I just want to know, Intel, is it going to close its gaps? And another thing, the S&P 500 has gaps since 2013, and now's a good time for them to close them, you know what I mean? If you go back from 2013, you gapped up in 2013 and 2014. So if you close them, you have like a 50% Fibonacci retracement, I think.
Yeah, well, hey, thanks for calling, Victor. Let's cover Intel first, and then we'll get back to the S&Ps, if that's okay.
Yeah.
Here's the situation on the weekly on Intel. It hasn't been, the best performer lately the past couple of weeks. I know you know that. We talked about 3202. Actually, I think we pulled this stock up, once in the past month, and we talked about that being the leverage point and kind of putting stops above. We'd have to get back above there to start thinking about this from the long side. Here's the daily situation. I'm showing these in the den. I don't know if you can see these. We've got a new profile attempting to appear here by way of that orange bar. Looks like pre-market we're trading 30.34, so we're not down that much. Intel, obviously what I'd like to see on this is to get back above 32 to start looking at this from the long side. I think the market in general is going to probably continue to relax a little bit off of this Greece news and the Shanghai news. I think the market's going to be
also Intel got rid of a lot of people are quitting. That's why I don't understand why it's rallying. They had some CEO leave and all that, and the stock rallies. Normally in a normal market it would go down, but whatever.
Yeah, I'm looking at the technicals, and I'm looking at the broad marketplace right now. I think that 2060 area is going to hold on the S&Ps, and I think that the market in general and every stock is going to be looking to China. They're going to be looking to the resolution of this Greece thing, however it shakes out. And I don't know if it's a good time to step in on the long side on stocks right now, and especially stocks like Intel that really, haven't shown their hand as a super strong stock lately. If I'm going to, put a gun to my head and make me buy stocks, I'm really going to continue to look at healthcare right now, if that makes sense.
The only reason I was looking at Intel is I wanted to close its gap and get around $27, you know what I mean? Because memory chips came down, their sales are slow, they bought another company.
Yeah, I think now you're talking. I mean, I'd like to pick this up cheaper, and I hear what you're saying now. Obviously that 27 area, that's the top of a box, 27.24 on a profile from a while back. And what we call this, Victor, is we call this a hole in the marketplace. It's actually interesting that you said that. I'd really like to see this come down to that. I think 27.24 is your mark on Intel. I thought you were trying to talk.
What about, I think those gaps will be filled, because according to Larry Pesavento, if you gap down today worse than you did last Monday, he said good, lights are out, because I got a feeling a few more gaps, you know what I mean? And there's people who will be getting called on their margin debit. You could gap down to 2013. You can't leave those gaps open on the SPYs.
Yeah, I think Larry's words of wisdom are, you got to take all those at face value all the time. He's great.
It's the same thing, but there's a different, you know what I mean?
Yeah. I'm a big fan of a lot of things that he says, and I don't think that people have actually, right now it's kind of like somebody puts their finger on your and pushes on your shoulder. It's always there. It kind of starts irritating you after a while. I don't think, same analogy, I don't think people have been pushed painfully wise enough to start thinking about the throw-up moves yet, even with the gap down this morning. So I think we're in for some more downside moves here on the S&Ps, and that may affect Intel. Thanks for calling, Victor.
Thank you. Thanks. Bye.
Okay.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's Nadex.com. or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
Catch Larry Pesavento, a 40-year veteran trader. He uses pattern recognition, Gartleys, butterflies, ABCs, and Fibonacci in order to trade these markets. Trade what you see. Next on TFNN.
Hi guys, welcome back to the show. Looking at the 10-year really quick, just to give some numbers here. Reached a high this week already, 127.06.5, 127.11. We talked about that big area on the weekly. We obviously are above profiles on the daily. I'm just kind of astonished that the bonds and the notes aren't rallying more than they're rallying right now. But again, with any more bad news, we could just kind of get a pressure valve release here on the upside. So be prepared for that. But right now, I'm looking at the notes and the bonds and especially gold. I mean, this is just really, again, if I were a betting man, which I am, I'm astonished. I mean, this is, what more could you want than people to go into some kind of safety situation and want to buy, something tangible. That's not happening with gold. It's kind of showing its hand, 1170. Remember, we've had some news come out. We barely popped our head. Well, the Greek situation, we barely popped our head above 1170. Now we sold off again. We're trading right now, as of the time of this report, 1165, 1164.80. So again, not good news for gold. I think you've got a trading opportunity right now around 1170. if the stock market does what I think it's going to do and stay below 2060, you can use that area we just talked about on the weekly unfair lows on the S&Ps. We used 2075, 79 last week before I left to come back from Asia. 2060 now I think is the number. We've ratcheted it down. We've let the market come to us this morning. That was the only and first inflection point that we could pay attention to on the S&Ps. How does that affect gold? I think the market's going to continue to sell off. I don't know if gold's going to be the best bearish play right here, but considering all the news out there, but my God, it's just amazingly just down. I don't know how else to put it. This is blowing my mind right now, actually. But you got to, it is what it is. 1170 for shorts. That's your stops above, but longs, if we can get back above 1170, I think you just got to take a shot on the long side again, based on how the U.S. stock market is acting and some other things globally. So that's the way we're looking at it. November beans is something that I have missed out on a little bit. I've talked about this particular instrument getting back down below 913 to go short again. Hasn't happened. Missed a lot of the long play here. Kudos to John in Philadelphia. He's been talking about, a scare one way or the other on some of the weather patterns and a couple of other things that could affect this and just start pushing people out of these shorts. And again, that's what some of the profiles do for me. It keeps me out of trouble and allows me to hopefully look at things pretty black and white. And this has been a great long play that I have not been a big fan of going long beans, but again, kept us out of the short side. Let's take a look at one more thing. Got 45 seconds before the break. We're going to take a look at crude oil here and try to do a quick analysis. This is something we talked about, this particular product being range bound forever. 57.77 was the last area, along with 56.43, that would cause us to hold up and stay in that range. We've gotten down below. Now I think on the short side, stops above 57 based on your appetite for risk. 57.77, excuse me. And will we rally down here? There's nothing to really rally off of. Here's the 240s. There's no new profiles attempting to appear down here. We could sink even farther. And playing the trading range on crude oil, obviously there's been a little bit of a disturbance on that. And when we started having these breaches of the 57 general area and the retest, that was kind of the telltale sign. Remember, close below, go back and retest, or close above and go back and retest. Those are powerful signals. Guys, you've been great. Stay tuned. Larry Pesavento is next.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This is TFNN.